Hey everyone, welcome back to Corporate Decoder, the place where we decode the fascinating and frankly sometimes baffling world of corporate finance. Today we're re-diving into a filing that is all about the money the Dreyfus government cash management funds and their latest SMI annual report. Get ready for some serious financial deep dives before we jump in if you love getting these no-fluff breakdowns of SEC filings and understanding exactly what is going on behind the scenes with big companies. Make sure you hit that subscribe button right now. And hey, if you want to dive deeper and chat about these filings with a community of like-minded folks, join our Discord server. It is linked in the description below. Alright, so what are we looking at here? This is essentially a financial check up for the Dreyfus government cash management funds up to the 31st of July of 2025. Think of it as the company S report card for the first half of its fiscal year, telling us how it has been doing with its investments and its money. And let me tell you, these are incredibly important documents because they show us where the real money is and where it is going. Now, this is a US Securities and Exchange Commission filing, which means it is a pretty official look at the company's performance. It tells us about the fund size, its number of holdings, and how its assets are allocated. It also includes the nitty-gritty details of what they're actually investing in. If you're looking for the raw data, this is it. Let S start with the big picture numbers. As of the 31st of July 2025, the fund was managing a staggering $439 million, which is $143.4 billion. That is a lot of money, and it was holding a whopping 174 different investments. This tells us they're not putting all their eggs in one basket, which is generally a good sign for stability. Now for the really juicy part, the statement of investments. This is where we see exactly what the fund is holding. A huge chunk of its investments, a massive 50.4% as of the 31st of July 2025, is tied up in repurchase agreements. What is a repurchase agreement in super simple terms? It is like a short-term loan where the fund lends out cash and gets securities as collateral. If the other party can T-buy back the securities at the agreed price, the fund keeps them. This is a common strategy for money market funds to earn a bit of extra income. In this case, the fund had a huge amount, over $72 billion, tied up in these agreements with various banks like ABN AMRO Bank NV, Banco Santander SA, and Goldman Sachs and Company LLC. Then we have us government agencies' obligations making up 14.2% of the holdings. This includes things like bonds from the Federal Farm Credit Banks and the Federal Home Loan Banks. These are generally considered very safe. The fund held a significant amount, over $20 billion, in these types of investments. Another big chunk, 21.7%, is in US Treasury bills. Again, these are considered extremely safe, backed by the full faith and credit of the US government. The fund had over $31 billion invested here. And then there are US Treasury floating rate notes, which accounted for 8.7%. These notes pay interest that changes based on a benchmark rate, so their income can fluctuate. If we look at the total investments on the 1st of August 2025, the fund had over $139 billion invested. This is a massive portfolio, and the vast majority of it, 97.3%, was in these investments. The rest was in cash and other receivables. Now, let's quickly touch on the fund itself. It is called Dreyfus Government Cash Management, and it operates as a government money market fund. The goal here is pretty straightforward: to earn as much income as possible while keeping the capital safe and making sure the money is liquid, meaning it can be easily accessed. They're aiming for a constant net asset value of $1 per share. That is pretty standard for money market funds. Looking at the statement of assets and liabilities, we see the fund S total net assets were just over $143 billion. On the liability side, they owed about $2.9 billion to various parties, including Benay Mellon Investment Advisor, Incorporated, and affiliates. It is important to see these numbers because they show the fund S overall financial health. The statement of operations shows us how the fund made its money and what it spent. For the 6 months ending the 31st of July 2025, it earned a staggering $2.8 billion in interest income. That is a testament to the sheer volume of money they were managing. However, they also had expenses totaling over $197 million. These expenses include management fees, shareholder servicing costs, and administrative fees. It is good to see that a significant portion of these expenses, about $26 million, was effectively reduced due to an undertaking, which sounds like a commitment to keep costs down. After all the costs, the fund reported a net investment income of over $2.7 billion. That is a lot of profit generated from their investments. This is the money that ultimately trickles down to the shareholders. The statement of changes in net assets gives us a sense of how the fund S-value grew or shrank. Over the first 6 months of 2025, the net assets increased by a substantial $4.7 billion. This came from the net investment income they generated. They also distributed a substantial amount to shareholders, over $2.7 billion, which is how investors actually get their returns. Now let's look at some of the key ratios which are super important for understanding the efficiency of the fund. For the institutional shares, the ratio of net expenses to average net assets was a very low 0.16%. This is excellent, meaning a very small portion of the money invested goes towards costs. For investor shares, it was 0.42%, still quite reasonable. The highest ratio was for service shares at 0.96%, which is still quite low in the grand scheme of things for a money market fund. This basically means that for every dollar invested, very little is spent on operational costs, which is fantastic for the investors. And on the flip side, the ratio of net investment income to average net assets shows us how much return the fund is generating. For institutional shares, this was a solid 4.21%. Investor shares brought in 3.96%, and service shares, despite having higher expenses, still yielded 3.41%. These numbers are great because they indicate the fund is effectively turning its investments into income for its shareholders. Interestingly, the report includes a disclaimer stating that the views expressed are only from the portfolio manager and don't necessarily represent the views of BN. Mellon Investment Advisor Incorporated. This is standard practice, but it is a good reminder that these reports are factual accounts of performance and not necessarily future predictions or opinions. Now, pulling all this together, does Dreyfus government cash management funds look solid? Absolutely. They're managing a huge amount of money. Their investments are in very safe assets like US treasuries and government agency obligations, and their expenses are incredibly well managed. The net investment income is substantial, meaning they're generating good returns for their investors. The low expense ratios are particularly impressive, especially for the institutional and bold shares, meaning more of your investment dollars are working for you. The higher expense ratios for service shares, for example, are understandable as they likely come with a different set of services. However, it is always wise to remember that even the safest investments carry some level of risk. The report mentions interest rate risk, which could impact the value of their fixed income securities if rates rise sharply. Also, there is counterparty risk with repurchase agreements, which means the risk that the other party in the agreement might not be able to fulfill their obligations. While these are managed risks, they are worth noting. Overall, the Dreyfus government cash management funds appear to be a stable and well-managed entity, particularly strong in its core mission of preserving capital and maintaining liquidity while generating competitive income in the current market. The financial health looks robust. Alright, that is our breakdown of the Dreyfus Government Cash Management Fund's latest filing. What is your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.